From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Treasuries rallying for a third straight week, even as economic data in America keeps delivering, setting the stage for Chair Powell's next decision. We begin with the big issue, a bond market riddle.
The data is not just better, it's better than expected.
The question is, what is driving yields lower?
And that is a huge head scratcher.
There's a lot of supply.
Muted by the sheer demand of investors looking for carry.
Yields are low for a reason.
We have seen liability matching flows.
The Fed controlling the front end.
And we have seen foreign buying.
Data that's going to continue to look better.
We are going to head back towards 2%. But it's not going to be linear.
That's been the biggest question.
This volatility in bond market.
The asymmetry is really towards still quite elevated rates volatility and higher rates.
The Fed have done a very, very good job of continuing to sort of toe the line.
This whole idea that rates volatility can settle again already now seems a bit too early.
It's going to be setting the stage really for June.
Setting the stage for June. Joining us now is Blackrock's Jeff Rosenberg, Sankaran of Morgan Stanley, and Subadra Rajappa of Societe Generale. The bond market riddle. I want your take from each and every one of you on this particular theme. Over the last 3 weeks, we've had a rally, Subadra, in the Treasury market, yields lower, even as economic data is coming well. In fact, in some cases, many cases, better than expected. What's been your read on that, Subadra?
Well, the bond market's been priced to perfection for very, very positive outcomes on growth and inflation, right? So even though we got those very strong prints, I think the reaction was, well, this is very much in line with what we had expected. But after quarter end and after what was the worst quarter, I would say, in the last 4 decades, you just saw this buying binge come from a variety of investors, which kind of caught the markets by surprise. I think a lot of investors were still short the bond market. And had to sort of, cover their shorts in a rush. But, I think that this is, the bond markets are, especially given the volatility in the bond market, I think bond investors are still skittish and we're in the low end of the range. So I see prospects for perhaps higher yields from here on.
What's your take, Jeff?
I think there's two parts of it. One, in regards to the economic data and some of the intro cuts that you had there, it's a little bit of buy the rumor, sell the news. There was a lot of technicals, a lot of movement in terms of anticipation of this tremendous run of data that we continue to have today. And the second thing is that, yields got to a level where if we look through, I guess we're now calling it the Biden boom, if we look through this kind of temporary surge in activity to what the Fed is talking about, where we settle back in, kind of 1.8% core PCE or PCE inflation, 1.8% real GDP, yield levels in the back end of the curve got to fair value, reflective of those kind of economics. And so you got pricing to where it should be for the look-through, and I think that, coupled with the kind of positioning arguments, got us a little bit to the rally that we saw so far this month.
Sri, the positioning story is something that's come up in each response so far. I've heard it a lot over the last couple of weeks as well. Is that something that resonates with you? This wasn't about the data. This was just about positioning.
I think it's both ways, John. I mean, our thinking from Matt Hornback and the rates team is, one, on the technical side, you've seen the shift away from the Japanese sellers into U.S. buyers. So there is a strong technical argument there to the fact that there was a significant backup in back-end rates and there was more support coming in after that initial move. I think there is an element of fundamentals as well, in the sense that the reality of reopening, obviously that's up for more debate now, given what's happening worldwide with respect to the second wave of the virus. And also in terms of the Fed, the reopening, the initial leg of the reopening and the disruptions associated with it, obviously their willingness to look through that and the conviction that they have that they are going to keep the front end rates anchored, I think that's sinking in a bit more. So it's a combination of these two factors in our view.
We've certainly reset over the last couple of weeks. Subadra, I noticed the morning piece from SocGen this morning. I'll read it out for our audience. Published in the last 24 hours from the team led by Subadra. With the US economy at an inflection point and bond yields at the lower end of the recent range, we see room for yields to rise on strong data. Is that what you're anticipating in the weeks and months to come, Subadra?
Yeah, no, I think so. I think a lot of sort of bullishness has been priced into the bond market. And you're starting to see nascent signs of improvement in Europe, especially on the vaccination front. They seem to be ramping it up quite well. So they might very well be in a very good spot by the middle of the year. As far as vaccinations are concerned. And I think that's been something that's been holding back treasuries, because 3 weeks ago when this rally started, we looked at the treasury bond spread. That was around 200 basis points. And to us, we felt like the valuations in treasuries were a little bit stretched relative to where global bond yields are. Now, if these conditions overseas improve, you could see sort of a parallel shift higher in yields, with both bond yields as well as treasury yields going higher.
Better economic data and some people in credit taking some chips off the table. Sri, you're one of them. Triple C's pulling back from some of the winners just a little bit. Why is that, Sri?
So, John, part of the majority of it is just a valuation argument, just as Subadra was mentioning in the rate side. What we have seen is that the big re-inflation trade or the reopening trade has been to look down in quality and look for compression themes. And the way we're framing the credit market now is that going forward, it's going to be entering some kind of a consolidation phase of sorts. And in this environment, triple Cs, which work well as a capital appreciation trade early in a cycle, start to fade in a consolidation phase. And that's kind of our thinking, is in a high cash price environment and with a lot of the upside on reflation priced in. So we do want to be a bit more cautious with respect to how we're approaching the lowest strata of the high yield market.
Jeff, can you add to that? Reducing exposure to the early cycle winners at this point of the year. Too early or the right time?
Well, I think you got to take a little bit broader perspective in that, what you're seeing in triple Cs, what you're seeing in credit are some extremely tight valuations. The fixed income markets are more directly impacted by liquidity. But when we think about kind of the fundamental factor exposure or economic exposure, it's too early to take those chips off the table. We have a very positive backdrop. It's just how and what instruments are best expressions for that. So we also like reducing the triple C exposure, but not reducing the factor exposure. And we can find better expressions for that economic risk in equity markets and in specific areas of equities that have much better valuations than triple Cs. And you have a lot of the similar kind of raw economic exposure underlying both of those assets. So you can get a better value if you have a bigger toolkit to play with.
Jeff, that's a really important framework and distinction that you bring into the table. The framework that Morgan Stanley brings to the table, I think, is also quite compelling at the moment too. Sri, that this cycle is going to move quicker, it's going to burn hotter, and we're going to move out the early cycle pretty quickly. Sri, can you walk our audience through that thinking of Morgan Stanley if they're not already familiar with it?
So multiple legs to this. One is the inflation dynamic. We do think that there is a stronger inflation impulse this time around. And it does translate into some degree of a policy response, not immediately, but eventually, once the Fed starts to hike, there is a case to be made that they will have to kind of do more or move at a faster pace. That does translate into the concerns for the over-leveraged balance sheets and some of the weaker cohorts within credit coming under pressure in that environment. I think the other leg of it is also that when we think about it from the valuation versus where the fundamentals are, I think a lot of the fundamental reopening narrative has to be vindicated. We're not seeing that yet in terms of the improvement in quality of balance sheets. From a valuation standpoint, there has been a lot of upside or improvement already priced in. So it's a thinking around valuations having moved further ahead, and also that the inflation dynamics look different, which does mean that the policy response eventually will have to catch up, which kind of truncates some of this cycle. And the final point would be that when we think about the excesses from the previous cycle, we haven't really seen a big washout. So that's the overhang that we need to think about in this cycle.
Subadra, a couple of moving parts there. Let's pick out one of them so you can respond to it. This framework from Morgan Stanley, shorter, hotter cycle, does that resonate with you and the team at SocGen?
Not really, because, one, I think that the earliest the Fed is going to be hiking is perhaps middle of 2023. It's really hard to have a very clear idea of what inflation is going to be at that time. Yes, they've told us they're going to let inflation run a lot harder than they usually would. But ultimately, they have their own terminal Fed funds rate is at 2.5%. So they're not really expecting inflation to remain sustainably above 2%, because in 2023, they have core PCE coming back to 2%. So under those circumstances, I'm just not convinced we have enough information to think that the economy is going to run a lot hotter in the second half of 2023 and beyond.
Sri, I just want to give you the final word here, just to reply to that. What is it that Morgan Stanley's looking at specifically that is really fueling this debate within the bank, within the teams, cross-asset?
Two things, right? So it's the sustainability of inflation, which is driven by this combination of both monetary and fiscal acting in tandem. So the outcome could look slightly different. And the second element of it is also that specifically from a monetary standpoint, if the objective is to have a broader and a higher quality labor participation and improvement with respect to the unemployment rate being more broadly distributed, that does translate into question marks around how the wage inflation starts to shape up. I think those are two legs of the argument there.
These are the two legs of the debate right now, Jeff. If you've got a take on it.
Yeah, I'll add maybe the third part, which is, I agree that the combination of monetary and fiscal is certainly the big story on the potential for a more inflationary outcome. I think the challenge is, will the Fed really be able to ramp up and have the willingness to tamp down that inflation? Call this the Larry Summers critique. And the Larry Summers critique is to understand that the flat Phillips curve that we're currently benefiting from, that allows us to run at very low levels of unemployment because there's no inflationary response, is a double-edged sword. And the flip side of that is that, if you do see that inflation, the amount of increases in unemployment that are required to bring about a decline in inflation may be intolerable for the Fed, given its emphasis on that broader-based measure of employment, the preferencing of employment over inflation, the willingness to tolerate higher inflation. This is really, Jonathan, going to be, I think, an overhanging conversation that we're going to be worried about, which is this intervention strategy of fiscal and monetary works great. Yep. We better hope that it doesn't create some inflation, because it could be very, very painful and perhaps, in a way that the Fed is unwilling or unable to bear, which means you just end up with a higher inflationary outcome. So this is really the big picture risk of all the good news that we're getting in the economy today.
It's going to be a fascinating couple of years ahead of us. Jeff, Sri, Subadra, sticking with us. Up next on the program, the auction block, the junk bond bonanza rolling on with spreads for the riskiest debt approaching 14-year lows. That conversation coming up next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off here in the United States, where the Treasury delivered $24 billion of 20-year debt that was met with solid demand, a part of the curve where Fed purchases may increase and issuance might actually be smaller as the year progresses. American banks delivering a barrage of supply. Morgan Stanley pricing $7.5 billion of debt. JP Morgan following last week's jumbo issue with £2 billion of new issuance as well. And junk-rated US companies are about to set an April record, capping a 12-month issuance boom. This year's volume already close to $190 billion, 44% of 2020's total. Jeff Rosenberg back with us, Sri Sankaran and Subadra Rajappa with us as well. Jeff, I want to talk about portfolio construction just a little bit. You and I have gone back and forth on that over the last 12 months and how things have changed. And I think with what has happened with yields over the last 6 months specifically, many people have thought about bringing in duration, and they've taken on more credit risk, maybe gone into triple Cs, etc. You've made the point, and I think it's an important one, that people have reduced their rate exposure but increased their effective equity exposure, and maybe haven't thought about what that means for the broader portfolio. Jeff, can you just walk us through your thinking at the moment?
Yeah, a simple way of thinking about it is that high-yield bonds are not bonds. They're stocks in bonds clothing, which is another way of saying that high-yield bond effective exposure, or its factor exposure, is more equity-like. It's the highest credit risk instrument in the credit spectrum. I mean, obviously there are some higher risky stuff, but because of that higher credit risk component, you have a higher degree of equity correlation. And so when you put it in a portfolio, you got to recognize that that bond portfolio, though it's called a bond, isn't really behaving the way often we expect bonds to, i.e. bonds going up when equities go down. And so the more of the risky stuff, whether it's high yield or emerging markets or risky securitized, what you end up with is a portfolio that increases the income and the yield, which is great, but it does so by taking on more exposure to equity risk and equity factor exposure. And so if you have that in the context of a portfolio where you're thinking about your bond allocation as a diversifier, as ballast, well, you've lost some of that ballast. And so you got to recognize exactly what is the role that you're looking for fixed income to play, and recognize that you can't do both at the same time. If you're going for income, most of the income sources like high yield, emerging markets, you're getting the higher income because you're taking on that higher equity exposure, and that's the trade-off. So that's really the conversation around.
The piece of this that I think a lot of people are focused on is fixed income as a ballast in the portfolio. And Subadra, I just wonder at 150 whether that gets it done, if this is a pricing issue or more of a structural issue for this cycle.
Well, I think it's a structural issue, right? I think 10-year yields are going to continue to rise ever so gradually for the remainder of the year, and I think that so underperformance in equities is sort of a well expected event for this year. So people are grabbing as much yield as they can in out the risk spectrum, which is kind of what you're supposed to be doing when the Fed is active and it's actively purchasing assets. That trade might actually fall apart once they start thinking about tapering of asset purchases.
Optimal diversification then, Jeff, what does it look like? Does it depend on what your objectives are? Can you walk me through where the next step goes for you? You've made your point on rate exposure becoming increased effective equity exposure as you pare down rate exposure. What's your suggestion?
Yeah, so you really just have to recognize that the loss of the ballast in fixed income means your overall portfolio is riskier. And so the easiest thing, and what a lot of people do, is they just tolerate that. They accept more risk. But if you're going to accept more risk, you got to know what your risk tolerance is. So back in a year ago, people were kind of discovering how comfortable they were with that. If that's not acceptable, that's where the whole conversation around, alternative forms of diversification comes in. What else is out there for me to source as ways to get that diversification? And there's a number of different solutions in there. And then the other one is looking at what kind of risk am I taking on the risky side of the portfolio? And are there ways in which I can mitigate some of the risk that I'm taking on the areas of my portfolio that I'm looking for upside participation that maybe gives up a little bit of that upside participation, but truncates the downside? And so looking across those three landscapes, that's how I'm going to solve that portfolio problem.
So perhaps being more defensive in actual equity exposure, just as an example, Jeff.
Sorry, Jonathan,
perhaps being defensive in actual equity exposure. Would that be an example of what you're suggesting?
That's exactly right. So there's ways to formulate defensive equity exposure, right? So classically, we can think of min-vol as one example of that. Now, how you formulate those really matters, because sometimes there can be sector tilts in there that can undermine the performance of those definitions. There's other ways we do a version where we look through equities from a credit lens, and that credit lens lends a defensive characteristic to the equity investments. That's a way in which you can look at a strategy for defensive equity.
Sri, just wanted to give you the final word on this as well. Just thinking of Morgan Stanley on these issues at the moment. What does it sound like? What are those conversations within and around the team like at the moment?
So a lot of debate with respect to, one, the efficient frontier itself being lower, right? So clearly, rates at these levels, we think that it offers a decent balance. We're framing it as a carry and roll down, and that's kind of why Hanbach and team would have the 530 steepener. And again, within credit, we're thinking about the pockets of the market which do well on a Sharpe ratio perspective, just in a more range-bound environment. And that's the context in which you were saying investment grade, the lower quality of investment grade, and also some of the higher quality of the high yield market. Those are pockets which end up doing well in this kind of regime. So it's shifted from an all-out early cycle compression playbook to one where we're thinking about what does well in a more carry/sideways regime on both rates and the credit spreads.
Sri, Subadra, Jeff, sticking with us. Still ahead, the final spread, the week ahead, featuring a Fed decision and news conference from Chairman Jay Powell. More still to come. That conversation next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up next week, On Monday, the US Commerce Department releasing durable goods data. Tuesday, the Bank of Japan out with a rate decision. On Wednesday, the big day, a Fed decision and news conference from Chairman Jay Powell, plus President Joe Biden addressing Congress. And finally, US GDP figures out on Thursday and personal income data coming on Friday. Let's round out the conversation with Jeff Rosenberg, Sri Sankaran and Subadra Rajappa. Subadra, coming up next week, a Fed decision. Is this just a pause ahead of June for you?
Yeah, pretty much. But I think that the Fed is going to take baby steps, in my opinion, towards teeing up the market for some sort of an announcement related to taper sometime in the mid-year or perhaps shortly thereafter at the Jackson Hole meeting. So that's what we'll be looking to see if we get some change in wording. We'd also be looking to see if there's any sort of how they characterize the risks, because thus far they've characterized the risk to the pandemic as being dominating the outlook. But going forward, I think especially given the fact that the U.S. has 50% of its adult population vaccinated, we'll be looking to see if there's any change in the balance of risks.
Your view on the Fed, Sri?
So, effectively still maintaining that June is probably the timeline that they make some sort of announcement. But the risks are kind of to pushing the date out a little bit further. To some extent, the thought process being there is more risk with respect to how they're framing the evolution of the virus. And our kind of healthcare analyst forecast would be that it's still, the trajectory is upwards going into June. That probably gives them some degree of optionality to push out the date, but the base case still remains middle of the year, kind of for some kind of announcement beginning Q1 next year is what we're thinking about tapering.
A 30-second final word, Jeff Rosenberg, on the Fed next week.
Nothing to add relative to the other guests. I think that's the consensus view. Jonathan, what you missed for next week is the announcement of the American Families Act, I think, is expected for next week. That may end up being the bigger story.
Well, thanks for filling that in, Jeff. We appreciate that. That's why you're here. Welcome. I need your help sometimes. Jeff, thank you. Alongside Sri Sankaran and Subadra Rajappa. Thanks very much, guys. From New York City, that does it for us. For our audience worldwide, we'll see you next week at around about 1 p.m. New York time, 6 p.m. in London. As always, this was Bloomberg Real Yield. This is Bloomberg.